You know, every single company out there, from a brand new startup to a global titan, is constantly facing one defining choice. When you need something critical to grow, do you pour your cash into owning it forever, or do you just pay as you go to stay quick on your feet? It's really the ultimate question. Do you build the future, or do you subscribe to it? And this is a massive decision, right? I mean, are you pouring concrete for a gigantic factory that's going to be there for 50 years? Or are you just signing up for a software service that you could cancel next month? The choice has billion-dollar consequences that can literally shape the future of an entire industry. And the answer? Well, it's not simple at all. It's actually found in this constant tension, this high-stakes balancing act between two totally opposite ways of thinking about spending money. And these two forces are pulling modern companies in completely different directions, all at the same time. So at the very heart of this tension is what we're calling the Great Financial Divide. And look, don't let the name fool you. This is not just some boring accounting jargon. This is a fundamental battle of business philosophies that every single leader has to figure out. First up is capital expenditure, or what everybody calls CapEx. The easiest way to think about this, it's like buying a house. It's a huge, upfront investment in a physical asset that you're going to own and control for years to come, something you believe is going to create value long into the future. You're building for tomorrow. And on the other side of the coin, you've got operating expenditure, or OpEx. Now, if CapEx is buying the house, OpEx is like renting an apartment. You have these predictable, recurring payments for all the stuff you need right now, just to keep the lights on and the business humming along. It is all about flexibility and just maintaining today's operations. So, here it is, the core trade-off in a nutshell. With CapEx, you're building a fortress. You get total control, but man, it costs a fortune upfront and it locks you in for the long haul. With OpEx, you're basically floating on a cloud. You've got total flexibility, predictable costs, but you never truly own anything. It's the ultimate build versus subscribe dilemma. Okay, but this decision isn't made in some kind of bubble. Just when companies were starting to get the hang of this balancing act, governments and regulators decided to come in and rewrite the entire rulebook, completely changing the math for everyone. You see, for years, companies could keep these massive lease commitments, we're talking fleets of airplanes, chains of retail stores, off their main financial statements. But these new accounting standards, IFRS 16 and ASC 842, they changed everything. They forced companies to put most of these leases right onto the balance sheet as assets and liabilities, totally blurring the lines between renting and owning. And you can see the domino effect right here. Under these new rules, a simple rent payment suddenly gets split in two. It's not just a straightforward operating cost anymore. Part of it becomes depreciation, and part of it becomes interest. And because of that accounting trick, a really popular profitability metric called EBITDA suddenly gets this huge artificial boost. So the company looks more profitable, and it also looks like it has more debt, even though the actual cash leaving its bank account hasn't changed one bit. Now get this. At the exact same time the accountants were making leases look more like owned assets, the U.S. government stepped in and started pushing companies to own more assets for real. A huge tax reform bill created these massive new incentives for companies to go out and make big capital investments. So the big takeaway here is pretty simple. The government started heavily rewarding companies for buying new equipment, and, maybe most importantly, for doing the research and development right here in the U.S. By letting them take a 100% immediate tax deduction for these domestic costs, it created this incredibly powerful reason to build and innovate at home. So all of this sets up the central paradox of our modern economy. We have these two massive tectonic shifts happening at the exact same time, pulling companies in totally opposite directions. It's a technological tug of war, the subscription economy versus the AI supercycle. On one side, you've got this relentless push towards OpEx. The whole as-a-service model has completely taken over everything. And we're not just talking about software anymore. I mean, now you can subscribe to jet engines, to heavy construction equipment, to factory robots. You're paying for the outcome, not the machine. And this is huge for avoiding the risk of your very expensive tech becoming obsolete in a year or two. But, and this is a huge but, just as that subscription trend is hitting its peak, we get this massive pull in the other direction. You see, the generative AI revolution doesn't run on subscriptions, it runs on raw physical power. And that requires this capital-intensive, once-in-a-generation build-out of physical data centers and incredibly specialized hardware. And the scale is just staggering. The projected real estate value of all the new data centers we're going to need by 2030 just to power this AI boom is, get ready for it, over $1.2 trillion. This is a CapEx wave of truly historic proportions. So where is all that money going? Well, the breakdown is pretty clear. The vast majority of it, over 60% of all that new capital spending, is going to one thing: high-performance servers. These are the machines that are packed with the GPUs and the AI accelerators that form the very engine of this whole revolution. So, with these giant opposing forces pulling companies every which way, how do investors on Wall Street possibly decide who's winning? Well, it all comes down to the high-stakes valuation game and how these spending decisions translate directly into a company's stock price. This table tells a crystal clear story. The market pays a huge premium for companies that are asset-light, the ones driven by OpEx. A software as a service or SaaS company can be valued at 25 times its earnings, while a super capital-intensive oil and gas company might only get 5 times. And why is that? It's because the market absolutely loves businesses that can grow and scale without having to build a new factory for every new customer. But here's the thing. Savvy investors know there's a trap here. That popular EBITDA metric we were just talking about, it can be incredibly misleading because it completely ignores the money a company has to spend just to maintain the stuff it already owns. This is what's known as the EBITDA trap. And this is exactly why smart money focuses on something called free cash flow. Just think of it as the ultimate acid test for a company's health. It's the actual, real cash that's left in the bank after you've paid all the bills and made all the necessary investments to stay competitive. It's the one number that is almost impossible to fake. So how do the best CFOs navigate this incredibly complex world? They master the modern playbook. See, it's not about choosing CapEx or OpEx. It's about finding that perfect strategic balance between the two. But that OpEx subscription model, it isn't a perfect solution. In fact, it's created its own monster, SaaS sprawl. Just think about this. The average large company is juggling nearly 300 different software apps. And here's the kicker. An incredible 51% of those paid licenses are just shelfware. They go completely unused. It's a staggering amount of waste. And this brings us to the modern CFO's decision matrix. The best finance leaders out there use a framework just like this one. They ask, is the technology changing at lightning speed? Okay, then you subscribe. Is it stable, and are you going to use it constantly? Then maybe you buy. It's a sophisticated, context-dependent choice every single time. Which really leaves us with one final provocative thought. In a world where the accounting rules, the tax laws, and technology itself are all in constant flux, maybe the debate isn't really about owning versus subscribing at all. Maybe the only true, sustainable competitive advantage is just having the strategic flexibility to choose the right model for the right asset at exactly the right time.